This conference will now be recorded.
Morning, everybody. Can everybody hear me? Welcome to Options 101 Trading. Let's see here. Get my bearings and we'll get started. Very cool. Well, glad you all can make it on a Saturday morning. Hopefully the weather's good where you're at. And thanks for being the guinea pigs for my first Options 101 run. I've done quite a bit of teaching in my day, but I have not done a remote class like this before. So you guys are the guinea pigs and you'll get the benefit of my stumbles. And this will be recorded so you can laugh over and over again. So I'm told I have a face for radio and a voice for muting. So there you have it. I'll show my screen, my camera for a little bit here, and then I'll probably move it out of the way so I can get into the class. Just to mention how I'm going to go about doing this class. I do my best teaching when I'm not paying attention to the chat. So I'm going to take questions towards the end. So I'm going to try to pay as little attention to the chat as I can. We will take a break about an hour in for bathroom break or whatever, especially for me, getting up there in age, need that. So if you have any questions, you can put them in the chat. I will get to them. Most of the chat I won't see along the way simply because I'll just be focused. And the way I'm going to approach this is I've got a lot of slides, as you can see there, and some of them will go through very quickly. And I'm not sure that we'll get through them all, but for the most part, the volume of slides is more for your benefit than mine to have handouts and something that you can refer to in the future. And I'm going to try as little as possible to read from the slides and spend more time in the application so I can show you the various things that I'm talking about. So without further ado, let's get going here. See if I can put this in presentation mode. And hopefully you guys can see my screen. Somebody just type in yes or something. If you can see the first screen. Everybody can hear my screen or see my screen? Yeah, okay. Thank you, Brian. All right. Risk disclosure. I'm a financial advisor, but I'm not acting in my capacity as a financial advisor. You know the whole spiel, so I won't spend time on it. Just a quick second on my background. I am a personal financial planner and a CPA, and I've been trading for about 11 years now, and I started options trading about 10 years ago when a very good buddy of mine brought me kicking and screaming to the options world. And I really struggled to understand puts and calls and how to use them. And now I would say that for my own personal trading, 90 to 95% of my trading is done via options. It's if I buy the stock on a breakout or on a pullback to support, I'm usually using options and I'm going for stock when the options market is just not conducive to trading. So that's me. So for you guys, I want to mention that we're just going to really start with the basics. And if you've seen the handouts, the link to the handouts is in the chat, and it should have been emailed to you if I had your email address. So if this is your first time on options, this is going to be great for some of you who have familiarity with options. Some of this you'll find a little boring and a little too basic. Hopefully you'll still pick up some stuff off of here, but based on the amount of time I spent preparing for this, I can imagine that this is going to translate to about 2 or 3 sessions of 1 to 2 hours each, and it could go even further depending on whether there's interest. And in any case, some of the stuff might be difficult to grasp at first, but repetition is the mother of learning. So you'll find out that the more you look at the stuff, hear the stuff, the more it starts to sink in. But I'll do my best in a forum like this to help you understand the basic concepts. Now, we're not going to set you off into, going off and starting trading like mad next week just because you have the initial basics course. I wouldn't encourage you to do that, although you may find you want to dip your toe into the water. So today is going to be about kind of stepping a toe into the water and getting you introduced to the terminology, the vernacular, and get you going on at least understanding what you're looking at on the screen when you look at an options screen. So everybody knows that the key to success in trading is risk management. And the thing I love the most about trading options is that it is a great risk management tool. That's what I find it primarily beneficial to. So if you're not using some form of hedging either in your trading or in your investments, you're going to be at the whims of the market. And if you learn how to use options for hedging and reducing risk and even increasing income, you're going to find that over time you're going to be a much more successful trader, and you're going to find that you're going to make more money because there's a lot of reasons that options will help you with your success. And there's a lot of reasons where options can really give you a false sense of security, and I'll try to point out when that is. So if we talk about the history of options, if we go way back, believe it or not, there's a long history of options, even used with commodities in the olden days, as they say. I didn't really dig too much into the history of options, but I even know from the reading of Reminiscences of a Stock Operator that there was speculation in options back in the 20s and 30s. And so options go a long way back. It's not a newfangled thing. It wasn't until the 1970s where it really became kind of more widespread. And as I'll talk about, it started with the establishment of the Options Clearing Corp and option exchanges. So you see some option Greeks, and a couple of these we'll touch on today, delta and theta. But in future courses, we'll get into these into much more depth because we still need to walk before we run. So delta and theta will be essential to understand, but the rest of them are more advanced concepts that you don't need to know right off the bat to get into options trading. When you think of an option, you can think of it as an instrument that is a separate and distinct from stock. When we think about trading or we think about investing, we think about Apple, we think about Cisco, we think about Amazon, Netflix, whatever the stock that we want to trade, we want to buy it, we go out, we buy 10 shares, we buy 50 shares, we buy 100 shares. Think of options as a separate trading instrument that is bought and sold just like stock is on different exchanges. So there are 12 exchanges, and wherever you trade or wherever you buy or sell your option, you don't have to buy it on the same option at the one exchange and sell it at the same exchange among the 12 exchanges. And usually when you're buying or selling an option, you don't care where it's being, who's picking it up and who's buying it and who's selling it for you. you're agnostic, and you don't have to designate which exchange you want it to be bought or sold out of, but you can in most trading platforms. So what are options? Okay, options are known as a derivative. They are instruments that derive their values from some other underlying instrument. So you can trade Apple all day, you can trade Netflix all day, and trade shares of stocks. You can buy Netflix, you can buy Apple, you can sell Apple, you can sell Netflix, but you can also sell at the same time or buy the options on Apple or the options on Netflix. So any option derives its value from another instrument. Another instrument that derives its value from another instrument is a futures contract. I'm sure you've heard of S&P futures, NASDAQ futures, bond futures, frozen concentrated orange juice futures. All of those are derived based on the value of either an index or some type of instrument. And these instruments that you're trading as options, these aren't options that are issued by the company. We're not talking about employee stock options. We're talking about options that are set up and listed on these exchanges by the Options Clearing Corp. And if a company goes bankrupt, it has nothing to do with what happens with the options. Obviously, your options will change in value, and if it's a call option, which we'll talk a lot more about, will probably go to zero, but for the most part, the corporation that issues the stock has nothing to do with listed options on the exchanges. Those are strictly controlled by the Options Clearing Commission. Options can be listed, as we just talked about, or they can be over the counter. Over the counter was far more common in the olden days, as they say, and those are mostly customized options that are set up for companies looking to either hedge a position. It's kind of a one-to-one kind of thing where a company says, look, we have a whole position, we can't find the right listed options to hedge our position or to offload some of the risk. So they might go to a Goldman Sachs or some other company that makes markets in over-the-counter options and make a deal with them to create those options for them. They're far more illiquid, but for the person buying and selling them, they suit a purpose. And you know, all you have to do is go back to the days of Bear Stearns that went under, and basically a lot of the contracts that they had were over the option contracts that, you know, there was no clearing corp to back them up on those forward contracts on the mortgage-backed securities, and that's what did them in. And so when a party or a company backs a particular option, they really have the full responsibility and bear the brunt of any risk that they're taking. There's no clearing firm or options clearing corps to help them out. So why do we want to trade options? Lots of ways to profit from options. Options can give you a lot of leverage, which means that you can go out and buy today 100 shares of Apple and pay $120 a share. So you need $12,000 of capital to do that. If you wanted to trade or control Apple, you can go out and buy just one call and maybe pay $500 for that call, control 100 shares, and you're still in the position of profitability that you would be if you bought those 100 shares. Obviously, if you're speculating on the next big drug company to hit it big with a COVID drug, or you're just looking for your next Netflix or your next Apple out there, but you don't want to have unlimited risk, But unlimited upside, you can do that with options. You can also define your risk. If you're waiting for a phase 1 trial to come in on your favorite biotech or drug company, buying 2 or 3 calls on that drug company, if the news goes bad, all you lose is your investment in that option. If things go well, you can really hit the jackpot. But if you own the stock and the stock drops 50 to 60%, which is not uncommon on a phase 3 drug trial failure, you're going to lose 50 to 60% of the value of that stock, and it can be far more. Also, on earnings, more closer to home. You think earnings are going to be good? You want to speculate on them? No better way than to do it is with options, where you can define your risk and not lose a whole lot of money. More in the institutional world, you can do a lot of rebalancing in portfolios with options. Options, believe it or not, are a very good tax planning tool, but if you don't know what you're doing, you can really trip up your tax benefits, and I'll talk about that a little bit later. You know, in an IRA, in most IRAs, except that in most IRAs you can't short stock. And in some IRAs, you can't even trade options, but most, like TD Ameritrade and Schwab, let you trade options in your IRAs. But if you want to sell any stock short, that's illegal. It's not allowed to do that in the IRA. So you can buy an option to hedge or reduce your risk and profit from downside on stocks or funds. Option terminology, which we're going to get into in depth today. Premium. Premium is simply the money you pay or collect when you buy or sell an option, respectively. And we're going to talk more about that. An option is a decaying asset, which means that it has a finite life and it will expire at a certain point. So when you buy or sell an option, that's one of the choices you have to make. How much time do you want to be right with that option? And that's the nice part about options. It gives you time to be right. That time comes with a cost, as we'll get into. The strike price, this is where your line of demarcation is in terms of where do I want to make my line in the sand with this particular stock? Where is my starting point of profitability, either up or down, depending on what type of option I buy? Exercise. We're not talking about going to the gym. We're talking about buying an option and deciding, well, I want to convert this option into the actual underlying, either the stock or the exchange traded fund or a futures contract. So if you're someone who would rather be a seller of an option than a buyer, you can be assigned. It's kind of the opposite of being exercised. The person who owns the option or buys the option has the right to exercise it and convert it into stock. The person who sells the option can be assigned, which means that the person owning the option can say, hey, you who sold me that option, and you don't know who that is. It's all done through the Options Clearing Corp. You don't care who that is. It may be just a market maker. Hey, I've decided to take my options, convert them to stock. Now you got to deliver that stock to me. And the person who's short that particular option has to either deliver the stock or is forced to take stock from you if it's the put type. In, at, or out of the money, we'll get into that in a little bit of depth to understand it, because basically at the money means what's the current price of the underlying that we're talking about. So if we're talking about Apple at 120, at the money is an option that has a strike price of 120. Intrinsic or real value. This is where sometimes people get a little bit confused. Intrinsic value is just the real value of an option, and it does not include what is known as time value. And we'll get into these concepts a little bit as we get into more depth. So what are the option advantages? Obviously, leverage is one of them. If you can buy 100 shares of Apple for $12,000, but still control those same 100 shares for $500, well, then you've got 24-to-1 leverage right there, and you're going to basically make exactly the same amount of money. Well, not exactly the same, but just as much money as the person who bought the stock, with a lot less risk. As I mentioned before, you can also use options to speculate and limit your downside for any one particular speculation event. Options also can be sold to earn premiums. We're going to talk at some point about if you do own the Apple shares, how you can create some additional income. They call that covered calls, and that's going to be part of probably the next session, but we'll talk about that a little bit towards the end of this presentation. So it's a way to generate income, or you might say, hey, you know, Apple's at 120. I'd really like to buy Apple at 100, and I'm just not willing to pay 120. Well, you might be able to sell a put option on Apple at 100 and get paid to wait to take that stock, and we'll talk about that as well. As I mentioned before, options can be a tax planning tool, and so if you're approaching year end and you don't want to recognize capital gains on your stock, you might want to defer them. One way might be to either buy a put on the stock or sell a call on a stock to reduce overall risk, create some income, and perhaps defer capital gains. Some of the disadvantages of options is kind of the mirror image of the advantages. You know, if you buy that Apple call and by expiration it hasn't done what you expect it to do, which is to go up by at least the cost of what you spent, you're going to lose that entire investment. It has a limited life. So you hear often that most options expire worthless, but fact of the matter is, when you buy an option, you're defining how much time you're going to wait for you to be right about your direction in the stock. When you have an option, if you owned Apple, pays 82 cents a share in dividend, you don't get that if you own the call. You are basically holding an option that does not participate in the corporate dividend. You also have no voting rights. Remember, options are issued by the Options Clearing Commission and have nothing to do with the company itself. If you don't do it right, if you're not sure and don't know what you're doing, when you have a dividend from Apple, for instance, it's considered what's known as a qualified dividend in the tax speak, which means that the maximum tax rate on that your maximum tax rate on that dividend is 20%, and depending on your tax rate, it might be 0%. So if you disqualify a dividend from, if you turn a dividend into a non-qualified dividend, then that dividend becomes taxable at your max tax rate. So if you're in the 32% bracket or the 35% bracket, you're going to pay a 32 or 35% tax rate on that dividend if you happen to disqualify that particular stock by buying an option on it. And you may also turn your long-term capital gains into short-term capital gains if you're not careful. And if you talk too much about dividends around your friends like I do, you might find them avoiding you a bit. All right. Hopefully everybody's still with me here, and I haven't lost too many of you. Two types of two main types of stock options, calls and puts. Stock options are really a legal contract. They're a legal agreement. They are sold in contracts. And as you'll see in a couple of minutes, a contract or an option contract covers or controls 100 shares. So when you buy an option contract, you are controlling 100 shares. Now, there are many options that control 10 shares, but they have not really taken off as was expected, and they're not really used a whole lot. I very rarely use them myself, but they do come in handy if you need a smaller option on the likes of Amazon or Google or something trading in the thousands of dollars. Every option, as I mentioned earlier, is a derivative of another particular instrument. Could be a future, could be a stock, could be an index, even currencies. You can find options on European currencies and on the dollar, and you can also find options on bonds, debt instruments, and what have you. Each option has a strike price, as I mentioned earlier, and each one has an expiration date. Now, there are two styles for expiration. The first type of style is the American style, which means that American options can be exercised anytime up until expiration date. So if you are the holder of an option and you decide you want to exchange it for stock or the underlying instrument, you can do that at any time. And it's usually with a click of the mouse. You can ask your broker to turn your options into stock and buy the stock at that particular strike price that you have. European style options can only be exercised on the expiration date. So essentially, you cannot, if you buy an option, you have to wait until expiration to exercise it. You still can buy it or sell it at any time. You don't have to keep hold on to it to exercise. But if you want to exercise it, you have to wait until expiration. And we'll talk more about exercise and assignment later in the course. All right. So let's talk about calls. Calls, as I said, is a legal contract. Comes with rights for the buyer. So if you're buying the call, you have the right, but not the obligation to exercise that particular call. You're basically buying the right to buy that stock, but you don't have to. On the other hand, the seller of the option is obligated, if called upon, to deliver that stock. Now, the seller doesn't actually deliver the stock when the buyer wants him to. The buyer and seller are their transactions facilitated by the exchanges and the option clearing corp through your broker. So all the buyer has to do is go on this platform and say, exercise this option, and in a few seconds, that stock appears and the option disappears. And then overnight, the seller finds out that he was assigned, and the buyer and seller never know who they are. And if you are assigned on an option, it is totally random. Basically, the options clearing corp, it's kind of like a roulette wheel. They decide who is going to be assigned on all the open options that are out there and that have been exercised that night. So what's the best non-stock example of a call option? And the best example I could think of is someone knocks on your door, or you go to someone and say, you know what, I really love your house and I want to buy your house, but I'm not really sure it's worth what you're asking for. And I'm afraid someone else is going to buy this house. So if I gave you $2,000 to hold this house for 2 weeks, I can do my due diligence and I can decide to buy your house. how much do you want for this house? Well, the owner might say, well, I want $500,000 for this house. And I want, yeah, $2,000 to give you that option for 2 weeks to buy this house, and I will not offer it to anyone else. He makes a legal agreement to buy that house. The buyer or the potential buyer writes a check to the owner of the house for $2,000. Win, lose, or draw, that owner of the house gets to keep that $2,000. The owner of the house is the potential seller of that house. And the buyer of that option is the owner of that, if you will, call option. Now, 15 days goes by, the buyer does his due diligence, or potential buyer does his due diligence, and he finds out, hey, this house is really worth about $600,000. I'm going to exercise my right to buy this house because I can turn around and sell this house for 600 grand, and I just pocketed 100 grand minus what I paid this guy for the option. Easy way to make money. Now, if this buyer does his due diligence, or potential buyer does his due diligence and finds out, hey, this house is only worth $350,000, he walks away. He's out 2 grand. The owner of the house pockets the 2 grand. The owner of the house being the seller of that option to buy. He's happy. He keeps 2 grand. The other guy is happy because he didn't just spend $500,000 on a house that's only worth $350,000. And that's the closest non-stock related option example I can give you, and at least one that I use with my clients all the time to help them understand call options. Reasons for trading calls: you're bullish on the market. You think the market's going up, or you think a stock is going up, you buy it. Opposite reason to sell it: you're bearish on the market, or you don't think the stock is going to go to a particular price, you sell the call. Maybe you want some limited downside risk, but you want unlimited upside. Sounds great. What do you give up for that? Basically, the complete loss of the money that you paid for the option. You know, if there's a court case pending, you have an earnings report coming up, you've got FDA approval pending on a drug company, or some macro event, you're waiting on a non-farm payroll report. You're betting that the market is going to go down, so you might want to buy or sell a call. Let's say you've got a lot of money tied up in your stocks, and you want to reduce your risk. You can sell your stock and buy a call and reduce your risk quite a bit. Also, you may just want to redeploy your capital to something else. So replacing the stock with option can free up capital for other trading. Obviously, we talked about it gives you leverage. If you own Apple shares at 120 and you're willing to part with your shares at 150, well, then you can go out and sell a call at $150 strike, generate a few dollars, just like the person selling the home did. He basically wrote a covered call, is what it's called, on his house. All right. So the other side of the coin, and when I was learning options, puts is what I had more trouble with understanding, especially the sell side of puts. So it's not always clear in the beginning when you're talking about options, how puts work. But oddly enough, the example is much easier. The real world example is much easier. So a put options, basically, if you're buying a put, you have rights. And if you're selling the put, you have an obligation. So you own your Apple shares at 120, you're afraid it's going to drop to 100, you want to protect your downside. You say, I want to buy some insurance. That's the easiest way to put, wrong terminology. It's an easy way to say what a put is. So I own Apple at 120, I want to protect any downside under 110, so I'll buy a 110 strike put. So you pay for that insurance premium and you basically protect your shares under 110. And if Apple happens to drop to $80, well, then you're going to be able to put your stock to someone else, laugh in their face and say, sucker, you get my stock for $110 and it's only worth 80. On the other hand, if you're the guy looking to make income and you're selling a put for 110 and Apple drops to 80, you're none too happy because now you're out $30 less the premium you collected on that put. And we're going to get into this into much more depth a little later. So the person who sells the put is also known as the writer of the put. He collects the premium. You're basically becoming the house in a casino, or you're becoming the insurance company. You're saying, I don't think Apple is going to drop below 110 in the next 30 days. I want to make some money. So I'll sell him a put for, say, $200. And I'll take the chance in the next 30 days that Apple is not going to drop below 110. And I'll keep that $200 and I'll do it again after expiration. So a good example of a put in the real world is as simply as homeowners insurance. If you own a home of any value, you're going to have homeowners insurance, and you pay them what every year? A premium. Same with automobile insurance. And what if nothing happens to your car or to your home at the end of the year? You got to do it again the next year. You pay them another premium. And what if in the second year your house is hit by an earthquake or it burns down to the ground? Well, then you get to put your house to the insurance company. So you paid them $2,000 or $3,000 or maybe $80,000 if you're in Florida and suffering from hurricanes to protect your $1 million home. And if your house is destroyed, they're going to pay you $1 million to replace it or to rebuild it. So when you are buying puts, you are selling insurance. You become an insurance company. You're insuring someone's stock, someone who's nervous against something bad happening. And if you're buying the put, you're nervous and you want to protect your downside. So reason for trading puts, you're bearish on the market, so you buy the put. If you're bullish on the market, go ahead and sell a put because you can generate a nice stream of income with that. Same type of events where you might be worried about a stock going down because of a court case or a macro event or what have you. You want to put some protection in place. If you don't want to sell your stock because of generating capital gains, you can reduce your risk at year end without selling the stock and thereby protecting yourself. As I always say to my clients, whenever I have a position on or an investment for the long term, I never let the tax tail wag the investment dog. And so when it's time to sell, it's time to sell. And you could be looking to save 10 to 15% on taxes and cost yourself double or triple that in the loss of the investment. So a put is one way to kind of protect your downside. You want to buy Apple at 100? Sell a put at 100. Get paid to wait for it. And hopefully when it does get to 100, it hangs around there. But usually, as we'll talk about later, when you're selling a put, you're looking for a point of support where it's likely to hold so that you're not just willy-nilly buying a put or selling a put somewhere where the possibility of the stock blowing right through that is going to make sure that you lose a lot of money. All right, so kind of to summarize here, rights and obligation. The option buyer, also known as the holder, he buys the option contract, he has the right to buy, he has the right to sell, and he pays the premium. The option seller is also known as the option writer. He sells the option contract. He's either obligated to sell, he's obligated to sell the stock or in the case of a put, he's obligated to buy, he receives the premium. So doesn't have to be, you don't have to know the person who's doing it. It's basically 9 times out of 10 another market maker that's buying your put or selling you the put. And that brings me to the next slide. If I sell an option I don't own, who will buy it? So it's just like shorting stock. If you're going out to the market and you say, I'm bearish on Apple, I'm bearish on Netflix, I want to sell short 50 shares. You're borrowing stock from someone who owns it to sell it short. Well, it's a lot easier with option because there are market makers standing ready to sell you any call or any put that you want at the price that they think is fair and two-sided. So during trading hours, which is 9:30 to 4, you can buy and sell options anytime during cash markets. And when you buy a put or you buy a call, you don't have to hold it for a day. You don't have to hold it for a minute. You can buy it, and if your stock does what you expect it to do, you can cash it in mere seconds later. There is no particular holding period. The IRS will love you because you'll have short-term capital gains, but for the most part, you are free to buy or sell the option as quickly as you can. Now, if you are a trader with a small account, and that's an account with less than $25,000 in it, you can be subject to pattern day trading rules. And that means that if you commit more than 3 day trades in a 5-day period, which means buying or selling the same security in the same week, and you have done it 3 times in a 5-day period, you could be restricted from future trading. It's the silliest rule in the world, and it goes back to the .com bust where they put it in place, FINRA. There's a lot of people working to revoke that. But the nice thing with options is that if you buy and sell an option and you want to go in for round 2 or round 3, all you have to do is pick a different option and you're not buying or selling the same security. So that's a way around the day trading rule. You just pick a different option, a different expiration, different strike, and you can get around the day trading rule. All right, so we're getting closer to kind of getting into an option screen. So bear with me for a few more minutes and we'll start looking at what we're talking about a little bit more and make this a little bit more tangible. The basics, the option particulars. When you are buying or selling options, you will see things on your broker's platform. Because options are open and closed, you can buy them to open, which means you're just making an opening trade. So when you buy the option, 2 things can happen. You can sell it to close it, or you can exercise it to convert it into stock. If you decide that you want to be a seller of options, it's called you're selling to open that option contract, and when you are ready to close it, you buy to close it back. So the exchanges are constantly keeping track of how many options of a particular company, of a particular expiration, of a particular strike are actually in customers' hands, and we'll talk about that more. It's called open interest. All right. Let's take a couple minutes and a couple more terms, and then we'll get into the platform. You're already learning a whole new language here, and there's a few more things you should know. Obviously, I just said buyer of an option is an option holder, seller is an option writer, and if you're writing and buying calls, you're probably known as me, a spastic trader. As I mentioned earlier, options trade in contracts, not in shares. So when you think of trading stock, you think in terms of 5, 10, 50, 100 shares. When you're trading an option contract, but for the mini option contracts, which I'm not going to really talk about because there's just not enough buys and sells in there to make it liquid enough to transact. You are basically buying a contract to control 100 shares. So because you are buying a contract that controls 100 shares, you know, sometimes when they refer to buying a call for $5, you have to remember that it's $5 per share. So when you're buying a call at $5, you're really out of pocket $500. If you're buying 2 calls, you're basically controlling 200 shares, 3 calls, 300 shares, etc. So when you buy that call, you're basically controlling 100 shares. You're buying the rights to 100 shares. So you're going to have to pay for the option. But option prices are quoted in dollars, but the total cost of that option or the total premium of that option is 100 times that cost of the option. Okay. Premium is the price a buyer and holder of an option pays and which the seller, writer, an option receives. Okay. Price is set by buyers and sellers in the transaction and options market where the option is traded. Okay. This is what I just said. Premium is quoted on a per share basis. If the $100, $120 strike are trading at $5, that means you're paying $5 per share or $500 total for the one option contract. Okay. What determines the option pricing? There are 6 different factors, or the abbreviation used long time ago, divots. Okay, these are the things that can influence an option price. But for our purposes, the most important part that affects options is volatility. And volatility, I can tell you, will be a discussion for one of the next sessions. But if there is one component of the option price that can have the most profound effect, other than the underlying stock price and the time, it is volatility on the price of the option. Obviously, where you buy it and how much time you have also affect it. And since you are buying a leveraged or in a sense, a borrowed instrument, interest rates definitely affect the prices of options. If the stock has an upcoming dividend, it can have an effect on the price. Although you don't collect the dividend and there's really no money to be made gaming dividends in terms of the options, when you're buying or selling around a dividend date, it will affect the price of the option, but it all comes out in the wash. You don't really pay for it. You don't lose anything. They just want to make sure that the prices adjust to account for the upcoming dividend. All right. So the strike price we talked about, it's a price at which the option allows the buyer to hold or the writer to sell the underlying stock. And the strike price is not negotiable, which means that it's the option clearing corp that sets the different strikes, which we'll look at in just a second. And they could be in 50-cent increments, $1 increments, $2.50 increments, $5, $10, $20, $25, whatever they want. Okay. And basically, the strike price is your starting point for buying or selling an option because you want to decide where you want to enter kind of the game. And what we're looking at here is a series of options that expire in September with a 50-cent strike increment. Okay. So let me pause right here and flip over to the platform. And let's take a look at some of these things that we're talking about. All right. What you're looking at here is the Thinkorswim platform, and we're looking at the trade page. When you look at an option, this is called kind of the option chain, because there are so many different options. And let me kind of lay out what you're looking at here. Up here is basically the underlying instrument that you want to trade, in this case, the QQQs I've selected. It closed Friday yesterday at 283.58. It's a NASDAQ stock, and you can see right here the bid and ask, as well as here. You got all the information about where the stock closed, traded, high, low, etc. Over here, you're seeing all the different expirations for this particular options. And as you can see, this particular option has some of them that are in white and some of them that are in yellow. And what you're looking here is the yellow ones are the weekly or non-standard expirations. Okay, so if I go back to the PowerPoint slide, the regular options expiration is the Saturday following the third Friday of the month. If there are options trading on a stock, and not all stocks have options trading on them, they will expire on the third Friday of the month. Well, they actually expire on Saturday, but the markets are closed on Saturday, so really you have until 4 p.m. Eastern time on Friday to close out your expiring options or have them assigned or exercised on your behalf by the Options Clearing Corp. Weekly options on over about 500 names expire every Friday. And if you want more daily fun, some instruments like the SPY, S&P 500 fund, and the SPX have Monday, Wednesday, and Friday expirations. So you can have 3 times as much fun. And I really think that the introduction of weekly and intra-week options has really dampened a lot of the volatility in the options market, because there's a lot of players out there that are, all they do week in and week out is buy and sell options in hundreds of thousands of contracts, and having these extra expirations tends to dampen the volatility because you have a lot more volatility spread out over a lot more options. Okay. So the ones that you see in yellow are non-standard expirations. And the way to read it is, this particular option is expiring next Friday, September 11th. Over here you see, make sure you can see my cursor, and let me make sure my cursor is shown here. So right here you're seeing the number of days to expiration. These are the ones that expired yesterday. Right here you're seeing the next options expire in 6 days, 13, 20, 25. These are quarterly options. And 100 means that these are standard options. They represent 100 shares per option. Okay. Down below, you see some option statistics. We won't get into those, but let's open a standard option chain, as they're called, so I can highlight for you the various details. Now, as you can see, once I expand this particular chain, don't panic just yet. I'm going to try to explain what you're seeing on the screen here. And these particular option chains have a particular layout to them, which, as you can see, I've created custom ones for my own self. I have a whole bunch of columns here, but I'm going to choose one of the standard layouts that they provide. Okay. Actually, I want a different one. There we go. All right. So I'm going to scroll through here and then kind of describe what we're looking at here. So right in the middle here, you can see the expiration in addition to seeing it up at the top left of the screen. Come on. Okay. Not the drawing tool I wanted. Okay. So in the middle, you see the expiration. Here you see the strike, and on the right-hand side, you see the puts. So the strike applies to the puts and the calls here. What you're looking at here is the strike price. Where do I want to transact business with the rest of the world in terms of my puts or calls? So this strike is the same for the put or call that you see listed here. And as you can see, in a fair market where the QQQ closed at 283.58 yesterday, the at the money call, which means that at the money being at the price, this is the closest to at the money, the 283 call, because that's where it last traded. So what does the information mean here? All right, the bid and ask. If you want to buy this call, you're going to pay 805. If you want to sell this call, you're going to pay 783. Now, can you sell that call if you don't own it? Absolutely. You can write a naked call if you have the margin in your account to cover the cost. And you can also buy it. So just to give you an idea, I have a portfolio margin account. So if I want to buy this particular call, maybe this account is not the portfolio margin call. I'll click on it and I'll click on confirm and send. The order confirmation dialog saying, confirming I want to buy one QQQ September 20, 283 call. Okay. It expires in 13 days. It's going to cost me $805 because it's $8.05 per call for the call times 100 shares. That's 805. My commission is 50 cents. It's going to cost me $805. That's the buying power requirement. Cancel that. Now instead, if I want to sell that call, I'm going to collect how much? Well, $783 minus the 50-cent commission. $782.50 is going to be deposited into my account immediately when I sell this call. And now I am on the hook for this stock at the price of $283 because I just obligated myself to furnish 100 shares of QQQ for $283 any time between now and expiration. The reason this says illegal 1 share is because I am in an IRA account. So let me try a different account. All right. So if I were to sell this call here, you can already tell that the buying power effect or the margin effect is much more. Actually, it would be a lot more if this were not a portfolio margin account. A portfolio margin account is an account that allows you to take much bigger positions in your account per dollar available in your account than you could if you didn't have portfolio margin. It's just kind of margin on steroids. But in this case, it's still going to cost about $1,737 of buying power to put this trade on, more than twice the cost. If this were not a portfolio margin account, this probably would cost you about $17,000 of buying power to put that on. Okay. The next column here is open interest and volume. Volume is basically how many of those option contracts traded that particular day. 4,882 traded. I'm going to switch a little bit here, something cleaner. And you would see this updated in real time. So if we bought one of these calls, the volume count obviously would go up by the number of calls we bought. If we sold one of those calls, the volume would go up. The open interest column basically tells you how many of this particular contract is still open and in the hands of traders. In this case, 12,799 contracts are in the hands of traders. The open interest changes every time someone opens or buys or sells or closes, either buying or selling, that particular contracts that they have in their account. And while volume is updated every second in real time, open interest is only updated once a day at the end of the day. So this number will not change again until Monday night. So everybody transacts their buys and sells, and it shows up in volume, but you won't see a change in open interest. So if someone came in on Monday, had 1,000 calls of the 282 strike, and they basically closed them out, they bought to close or they sold to close based on what their position was, you'd see an open interest 11,099. And why is that important to know? And in fact, it's one of the most important things to know when you're trading options, because open interest is a measure of liquidity. It means that you're going to get tight bid-ask spreads. Okay, if I switch over to the SPY, it's an instrument, it's the S&P 500 ETF with one of the tightest bid-ask spreads and one of the most liquid options that you can trade. Notice here that I'm scrolling through a lot of options here because I have the number of strikes set to 200. I can set it to just 14 and significantly show less on my screen. As you can see, the SPY is one of the highest volume traders. This particular 342 call and 342 call has an open interest of 86,160 contracts. And keep in mind, this September expiration is also an expiration for the quarterly futures contract. So it tends to have quite a bit of open interest in it because this is what a lot of the market makers and the institutions traffic in. When you see a huge number in this, you can be comfortable that you're going to have very tight bid-ask spreads. And in some cases during the day, if we were during a trading day, you might see bid-ask spreads that were 1 to 2 pennies apart. And you can't ask for better markets than that. When you're trading options, whether it be calls or puts, liquidity is king. You don't want to look or trade options that don't have a good amount of open interest and a good amount of volume. You're just going to be paying for that market maker's private island, plain and simple. You want to trade options that have tight and liquid markets. And what am I looking for in terms of open interest? I'm looking for at least 150 contracts, preferably 500 or more. If I don't see 150 contracts, I don't touch that option. I've learned that lesson. I've been burned by buying illiquid options. In that case, if I really want the stock or I need to trade a breakout or a pullback to support, I just buy the stock. Plain and simple. Do not traffic in illiquid options. You're just going to cost yourself money. And what you might find is that it's easy to get in. It's kind of like the Roach Motel. You can check in, but it's very hard to check out, because even if you get a good price buying the option, selling it is going to cost you dearly. And sometimes you won't even find someone to buy that option you have. So you have a really nice trade. It's going in your direction. You're making a lot of money. But when it comes time to close that option, everybody's left the building and you're left holding an option that nobody wants to buy, even though you have plenty of money made. Now, you can wait till expiration, and if you're deep in the money, you will get, you can exercise it. But if you don't have the money to pay for the shares in the first place, then you're going to be stuck. Or you have risk of waiting, perhaps, and by the time you're exercised, if it's a quick trade, you might have lost the money. Or it could be that you sold the option and you're waiting to get out of it, and the market maker, or there's just nobody trading in it. So big emphasis on good open interest. Volume is important, but not as important as open interest. Okay. We looked at the calls. Now I want to show you something. We said we're going to talk about in the money, at the money, and out of the money. At the money, in the case of the SPY, is around $342. It's at the money because that's the price it's trading at. Let's look at a 345 call. A 345 call is 480 bid and 490 ask. You want to buy it, you're paying 490. You want to sell it, you're paying 480. On the Thinkorswim platform and other platforms, I always start midway between the two. And 8 times or 9 times out of 10, I will get filled at the mid if I'm patient enough. Okay. When you're putting in an order for an option, 99 times out of 100, it needs to be a limit order. If you are going market on an option, you are at the mercy of the market maker or the other person, or the person taking the other side of your trade. Okay. Chances are you're going to get filled at 490 if you're buying the option, or 480 if you're selling the option. 99 times out of 100, I am putting in a limited order. It is tempting to put in a market order on a runaway stock. There is no guarantee, and you can't go crying to your broker if you get a bad fill price because you went with a market order. I did it in my early days and I got burned. Don't make my mistake. If you can't get filled, you can come back and replace your order and up your bid. Or if you're trying to sell or buy a put, sell a put, say here, again, put your bid down here at the mid. If you're patient and there's no hurry, you can leave that order out there. Eventually, as the market moves, you may or may not get filled, and then you may have to move it. Sometimes you just don't get filled, and you have to keep trying. I'll temper my warning to you in an instrument like SPY or QQQ, where you have a ton of open interest, and the market's moving fast. You won't get hurt terribly with a market order because it's a fairly liquid and open market. But again, you will pay the ask if you go market, and you will get paid a bid. And sometimes you get lucky, you get price improvement better than you expect when you go with a market order. But I rarely, if ever, do a market order. Let's switch back to calls here, talk about in the money, out of the money, and at the money. At the money here is 342. Out of the money is anything over 342. Why do I say that? Okay. I want to talk about time value, and I want to talk about intrinsic value. But I want to first take about a 5-minute break, and then we'll come back and get into those details. Okay. We'll be back. It's 11:12. We'll start back up at 11:17. Okay.
This conference will now be recorded.
Okay, so we're talking about stops on options, and they can vary, and it depends on your personal risk tolerance for the most part. So some traders do it at 30%, some at 40%, some at 50%, some at 60%. Some basically say, I'm willing to risk the entire premium. And I've defined my risk, and I'm going to risk the entire premium. You get whipsawed unless you have no stop at all. You are at risk of whipsaw at any particular stop level, and I've tried them all, and there isn't a good rule of thumb. But in my opinion, 50% is the ideal point, because if you're expecting to double your money and you want to have a positive expectancy, giving up more than 50% means that you're probably wrong about the trade or the timing of the trade, and you want to probably get out. And like I said, I know other traders that use 30%. They get stopped out a lot more often than 50%, but they are still profitable traders. So you gotta figure out what works for you. Now, if you're selling a put or you're selling an option and you want to know when to get out, as a general rule, if I sell an option for $5, a naked option, then if I need to buy that option back for double that amount, I will start to think about closing out that trade. I'm probably going to be wrong. And I'm probably going to owe some money on that short sale. And I know traders who will go 2 times their premium before they close out a put sale. Again, I wouldn't go more than 2 times what you collected before closing it out, and 1 time what you collected, meaning that you sold the call for $5 or you sold the put for $5. And now if you had to buy it back, you're going to pay 10, basically taking 100% loss on your premium is a good rule. So Larry, to talk about margin a little bit. So if you are not in a margin account, basically you have maybe you do have an account that's on margin. I think you need margin to, you got to have margin on the account to trade options. If you are in a normal options trading account, when you're buying a call, the cost of the call is basically what you is the margin that is subtracted from your account, or the buying power that's subtracted from your account to cover that particular option. When you're selling a call, that really depends on the broker and where they set how much margin you need to sell that particular call naked, whether it be a call or a put. For a put, most brokers will set you to cash secured, which means that if I were to sell a put on the SPY at 340, and that would be at 660. So let me make sure let me try to highlight here. So if I want to sell this put in a cash secured put position, that means I'm committing to buying 100 shares of the SPY at $340. And that's $34,000 that I need to have in my account to be able to buy that put. Sometimes even after you've bought or sold an option, mostly when you've sold an option, when you're short an option, and volatility increases in the market, brokers do and will increase margin requirements overnight. They will just decide to do it. They don't have to wait for permission. They don't have to notify you. They might just decide that they don't want to take that risk anymore, especially with short puts and the market's volatile and going down. So something that used to require a lot less margin suddenly requires more. Now, if you're short, if you're in a regular margin account and you only need 34,000 to cover this, that's the most that you can lose, then they're not going to increase it above that. But if you're in a margin account where they don't require you to keep 34,000 in for a cash secured put, maybe they give you 50% margin, meaning you only have to have 17,000 available of buying power to sell this put. Then if volatility picks up, they might increase that margin requirement and force a margin call on you. So Anthony, open interest is more important. The key about open interest or about volume is it can disappear the very next day. So the very volume is good for that day. And if you're planning to get out that day, great. But it can dry up just as fast as it came in. And if there's no open interest behind it, you could be the lone guy holding the bag. So the next day you come back and you're ready to sell your call. Well, open interest is gone. Everybody sold out the day before. And now you're stuck with a wide bid-ask spread, and an option that you bought with a 10-cent bid-ask spread now has a $2 or $3 spread. I'll give you a good example. CMG, Chipotle, is a great stock, but terrible for trading options. Look at the 1310 call. Chipotle is trading at 1313. The 1310 call, or we can just go to 1300, which is slightly in the money, which I'm going to talk about next in our presentation. You can buy it for $54 or $5,400 is what it will cost you, and you can sell it for $4,500. Now, this is after hours and the spreads are really bad, but trust me, during the market hours, they're just as bad. This one has open interest of 454 calls and only 17 transacted on Friday. So even if this was 1,700, you come back the next day and there's no open interest, you're going to pay through the nose for that. And it's just going to cost you. You sold at 54, you can immediately buy it. You bought it at 54, you can immediately sell it for 45. That's a $900 loss you can take in a matter of minutes just on the bid-ask spreads. And here's what I say about trading these options. I don't care if this open interest is $10,000. No way in heck am I trading an option with a $9 spread. There's just no way. You just walk away. Trade the stock or don't trade it. These are an options market maker steak dinner. They love to sell these to you. I do not trade these options unless I can get them for a decent spread. Robert, been told in the past it's best to buy a call at or in the money. Buying out of the money is not good. Is that true? It's all in the context of what you're trying to do. So it really depends on your approach. And I'm going to get into this a little bit more, but it may be true in some circumstances and it may not be true in other. It depends on what your objectives are. If volatility is elevated, like it's now becoming after the last couple of trading days, buying deep in the money calls is a better option than if you're trying to go long something, going deep in the money is going to avoid what's known as volatility crush when the volatility comes in. Buying at the money means you're paying the most premium for that option. So I am going to be talking a lot more about where to buy the options coming up, but out of the money means that your chances of profiting on the option decrease a lot more because your chances of being right go down, and I'm going to talk about that in our discussion of delta. So just to tell you, there's no wrong or right place to buy an option. It just depends on what you expect the underlying to do. And we're going to talk about this more. Charles J. Talking about the taxes, that could be a whole webinar in of itself, and maybe I'll do one for traders, but here's the deal. Whether you want to set yourself up as a company or as a day trader status really depends on how much trading you do, what other jobs you have, and whether you are comfortable having all of your trades and profits be treated as ordinary income. Now, if you're losing money, it's nice because you can take unlimited losses. So what he's talking about is declaring yourself, as a day trader with the IRS and basically getting trader status. But that cuts both ways. Once you start getting insanely profitable, and if you hold positions for longer than a year, you lose long-term capital gain treatment. If you're only a short-term trader, it can be beneficial. Setting up a company, unless you have a reason to, it's not going to make a difference in your taxes. You can do it as an individual, report it on your individual return. If you set it up as a company, I'm not sure what legal objectives you have, but there's really no need unless you really plan to employ some traders or what have you, and you need to set up a company. So I don't want to murder your name, Sitha or Sitha. do you know where to enter and exit an option when the underlying stock hits X price? So you're looking for some conditional exits, and thinkorswim does have some conditional orders that you can put in. I can't get into them right now, but yeah, you can say when a particular stock hits a particular price, exit the option, but it's going to be a lot easier because option prices jump around so much, especially with a volatile stock, to set the price that you want to exit in at 40% profit, 50% profit, 25% profit, then try to trigger it with the stock price, because your stock price might go where you want it to go, and if the option hasn't moved, you just got screwed because the option didn't do what you expected it to do, either because volatility is collapsing or because nobody wants to make a decent market in your option. Brian, can the market maker see your stop orders on options? I do not put in stop orders on options. Options stop orders should be more mental or paid attention to yourself. Option prices jump around so much unless you're trading very liquid options like the SPY or the QQQs or sometimes Apple. You know, market makers can't see your stops per se, but what I found in the early days of trading options, it was a good way to lose a lot of money, because if the bid drops out for a few seconds and you have a stop set there to be at a certain price, and the price, the mid price that you have your stop set at drops, then you're out of that option and no real trades have really transacted. So while it's okay to put stops in on your stocks in the system, I do not recommend stops on your options. You have to do that mental stops and take them when you're ready. And sometimes it's a good thing, because you know the volatility can swing the value of the option a lot more than the stock price, and it's easy to for an option to just momentarily drop the price without notice, and then you get screwed because you had a stop in the system. And DD is saying exactly the right thing. You know, you get burned a lot of times when you put a stop on an option, it prematurely triggers. And with thinkorswim, I know at TD Ameritrade, they do not present your stops to the exchanges until they trigger. So all of their stops, all the stops you put on thinkorswim are not shown to the market makers. It's only presented to the exchanges when they trigger as a market order. So I know with thinkorswim, you don't have to worry about that, but what you're experiencing is not market makers. You're experiencing normal market and option volatility, and it's just no place for stops, I'm afraid. When to take a loss on leap calls. I'm not a big fan of leap options, although I do trade them from time to time. It really has to do, and the reason I say that is anything beyond 90 to 120 days in the life of an option, and we haven't talked about volatility yet, but anything beyond 90 to 120 days, you're paying for a lot of volatility that's unknown, and the market makers have to be compensated for a lot more uncertainty. So when you're going out 12 to 18 months to buy an option, you're saying that I'm comfortable with a lot of uncertainty around my stock. And I've seen leap options go from 10 cents to $10 in my trading career. And I've seen it go the opposite way. So if you wouldn't hold, if you would still be holding the stock, if the conditions or the thesis you have for getting in the stock was still valid, then I would hold on to the leap. Because you have a long-term thesis if you're buying a leap. If you don't have a long-term thesis, then you're paying for a lot of extra volatility that you're not being compensated for because you don't plan to keep it that long. And it really bothers me when suggestions are made to buy options 9 to 12 months out in the future, but the recommendation or the thesis is going to play itself out in 1 or 2 months. So don't. My sweet spot for buying options is 45 to 60 days. If I buy a leap option, it means that my story has a lot of time that it needs to run to play out. In which case, if I bought the stock, I would be holding it through that time period. If you won't be holding that stock through the leap time period, ask yourself that, then don't buy the leap. And I think I've gotten most of the questions. Let me scroll through. Okay, so let me continue here and go back to the presentation. So we said equity options expire the 3rd Friday of the month. And then we have the weeklies, we talked about that. Options volume we talked about, number of contracts that have traded on that particular day. And it's done on a real-time basis. Open interest, number of outstanding options that are open on that particular strike and expiration date. We saw that. Okay, so now we're going to talk about the key components of option premium where some people tend to get tripped up. Okay, now I told you earlier there are like 6 different factors that contribute to the price of an option. But for all intents and purposes, you only need to worry about 2 components. Okay, and that component is intrinsic value and time value. All right, now I'm getting dangerous. I have a pen in hand and it's a red pen. Intrinsic value, another word for intrinsic value is real value. Okay, another word for time value is extrinsic value. Okay, so let's go back to the platform and see if I can't clarify this for you. And I'm going to, okay, I'm going to switch to Apple. Look at the September option. So Apple closed at, let's say, $121 yesterday. So the at the money call expiring in September is at the money. This is the money. It's the closest thing to at the money. It's closer than 121.25, and it's closer than 118.75. Obviously, you know, Apple had a split. That's why you're seeing a lot of funky numbers in terms of the strikes, because it had a 4-for-1 split. So all the old $480 options are now $120 options. So before the split, if you had 100 shares of Apple, you now have 400 shares. And if you had 1 call option in Apple, now you have 4 calls in Apple. If you had A $480 call on Apple, you had just one of them. Today, after the split, you have 4 of the 120 calls. Just like the stock, the options also split. But your real position in Apple has not changed one bit. Hopefully that makes sense. At the money means where the stock is trading. You might notice a little subtle shade of gray here around these options. Let me see if I can, hopefully you can see my little cursor here. So, and the options that are below at the money are not shaded in the platform. And basically, it's meant to help you see at a glance which options are trading in the money and what options are trading out of the money. So let me explain what that means. If you were to look out at the 125 calls, they are going for $4.10 by $4 versus an at the money call, which is trading for $6. Okay. As you can see, going further out of the money, the option gets cheaper. Why is that? The fact is, the farther you go outside of the price of the stock, the less chance you have of making money on that stock. You know, what are the odds of Apple going from 120 to 125? Well, I'm not sure. We haven't talked about Delta yet, but I'm pretty sure the odds are better that it goes to 125 than it is to go to 128.75. So let me bring up some more strikes here to make it a little clearer. If you go up to 130, it gets cheaper. The farther outside of where Apple is trading, the cheaper the option, and the less likely it is you're going to make money if you're buying it. If you're selling it, let's say you own 100 shares of Apple and you want to sell an option against it, which we'll talk about more, you're going to get less. There's less chance that you're going to be assigned, but you're going to make less money. So the closer you get to where the stock is trading and outside of the real value of Apple, which is $121, all of this is known as extrinsic value, or time value is another word for extrinsic value. When you're buying or selling a call that is above where the price is, you are buying time value. You are just betting that in time, the stock is going to go up here and you're going to have a shot at making money, but not necessarily a guarantee. If we go to the $115 strike right here, that particular option costs, let's say, $9.20 right in the middle. Oops. You can see the shaded area saying that this particular option is in the money because it has some intrinsic or real value. So let's try to break that down. Apple is trading at, let's say, 121 for all intents and purposes, and you go out and buy a call at 115. All right. How much of that call that you've paid for is real value of Apple versus time value of Apple, like we have down here? And the answer is easy. Well, easy to me, for me, sorry. if Apple is trading at 121 and I paid $9.35 for a $115 call, well, I know that at 121, what I'm paying for an Apple in terms of real value is about $6 worth of intrinsic or real value, right? So bring up my calculator here. And Apple's trading at 121, and I'll subtract the strike price that I'm buying, which is, 115. Basically, my intrinsic value of that option is $6, because if I buy this option and immediately convert it to stock, I now own shares that are worth $121 that I paid for $9 for. I'm already, let me back up a second and rephrase that. If I buy this option at $9.30, and I wouldn't want to do this, by the way, I'm just saying it for hypothetical purposes. If I buy this option for $9.20 and I immediately exercise it, it buys me Apple shares at $115. And since Apple is trading at 121, I already have a $6 profit built into my strike. So if I have a $6 intrinsic value, how much is the extrinsic value? Well, I paid $9.20 for the option. The intrinsic value, or the real value of the option, is $6. Then there's $3.20 of time value built into this option. So the deeper you go into the money, here, if I take the 110 call, stock is trading at 121, I have $11 of real value in here. I'm paying, let's say, $12.85 for it. Then that must mean if I have $11 of intrinsic or real value, then the extrinsic value must be about $1.85, because I'm paying $12.85 for the option minus $11 of real value. This is what I'm paying for time value. So even though we're $11 in the money, there's still quite a bit of time value left, even for 13 days. And one of the reasons is, we know Apple has been volatile this week. It dropped from 130s down to 115 before recovering yesterday to 121. So the volatility has gone up, and therefore these deep in the money options now carry more extrinsic value. Does that make sense? And I'm figuring out a way. So if you do have questions, I'm going to try to catch them as we go along, just to see if I can stay on track and not get too distracted with the questions. But you know, Bob asked, what factors determine changes in volatility? Bob, that's a whole long explanation, but it's, and I'm going to get into that. That's a topic of it in itself, and it's usually an options 102 class. But demand for the options has an effect. Market conditions has an effect. What's going on in the macro, all kinds of things has an effect on the volatility. What's going on with a particular company, whether they have an earnings announcement coming up, as I mentioned earlier, Do they have some type of product announcement? All of that can have an effect on the volatility of a stock or a fund. But we are going to talk about volatility a lot more and how it affects option pricing. Okay. So understanding intrinsic and extrinsic value is quite important. And I should just kind of go through it with a put as well. So on the put side, you can see hopefully a little bit of a grayish area here because these puts are considered in the money. So at the money put here, I guess it's closer to 120, 125. I've been talking about 120, but right on the edge because it's right in between. So let's say at the money is, we'll stick with 120 as at the money, the real value of Apple. When it comes to puts and intrinsic and time value, this is what confuses most people, and it's a little bit harder to grasp. All right, but if we think about it in terms of our homeowner's policy, how much do we want to insure our home for? All right, so if I want $125 for my Apple shares because I paid $100 for my shares. I want to protect my profits. I don't want to lose any more than 125. I could go out and buy a $125 put. It'll cost me $800 or $8 for the option. All right. So how do we calculate intrinsic and extrinsic? And it's kind of flipping the whole call side on its head. So I'm going to pay $8 for this option so that I can get paid $125 for option for my Apple shares should it continue to drop. Okay, so what is my intrinsic value? Okay, same way to calculate intrinsic value for puts, except it's just kind of backwards. $125 is my strike price. Apple is trading for $121. I have $4 of intrinsic or real value in this put. Why? Because if I bought this put today and I immediately exercised it, I would get $125 for my Apple shares. On the other hand, if I paid $8 for it, it also has, I paid $8, $4 is intrinsic. I have $4 of extrinsic or time value in here. And that's for 13 days, guys and gals, 13 days. You've got $400, half of the value of this option is an extrinsic value. If we go down to the 115s and I say I want to protect my shares down to 115, well, those are going to cost me about $3.10 or $310. Okay. If on expiration Apple is at or above 115, because this is 100% time value. If Apple closes at or above 115 on expiration, this option will be worth nothing because I just bought an insurance policy to insure my Apple shares if they go down below 115. If Apple is trading at 120, well, my policy just lapsed in 13 days and it cost me $300 for my nervousness. And as you can see, the farther you get out of the money, further you set your policy. It's kind of like a deductible that you're setting with your homeowner's policy. You know, you're saying I'm willing to bear the first couple $1,000s or $10,000 of loss on my home should it be destroyed, the more of the risk you're willing to bear, the cheaper the insurance policy. The higher the deductible, well, the higher the insurance premium. By the same token, if you say, well, I wouldn't mind buying Apple for $110 share, but I don't think it's going there. But what I can do is say, I'm comfortable buying Apple at $110 a share. So I'll go out and sell a put on Apple at 110. Thinkorswim or TD Ameritrade will deposit in this case, $186 in my account, less commissions. And between now and expiration, if Apple never approaches 110, I keep this premium. If Apple is trading down at, I'm going to expand the strikes to 30 so I have more room. Oh, need more than that, 35. If Apple trades down to $100 by expiration, well, you're committed to buying Apple shares at 110. So even though Apple is trading at 110, at 100, you sold a put option on Apple, which said, I'm comfortable buying Apple at 110. So now I have to buy those shares at 110, even though Apple is trading now at 100. So that's the main risk with put options. And so to kind of go back to one of the questions, well, if I sold this 110 call and I really don't want to be stuck with it unless Apple gets down to 100, where should I get out? And I would say that if you have to pay twice this amount to get out, it's probably time to think about cutting your losses and buying that put back. Because if it does go down to 100 or it goes down to 95, you're going to lose a lot more than that. Now, one of the mistakes I've made more than enough times than I care to count is that when volatility and emotions are running high, people tend to panic and volatility ramps up. I saw yesterday, after the initial ramp into the open and then the drop, I saw puts that were trading on Thursday for 20 cents go up to $2 in a matter of 15 minutes. And that's how fast volatility catches fire. So when you sell a put or sell a call for that matter, you want to stay calm and there's nobody chasing you to close that option. If you see your put or your call that you sold is trading for multiples of what you bought, take a deep breath and maybe wait to the end of the day or the very next day, because the volatility is probably jacking that option big time, and you want to wait till the panic subsides and give yourself some time before you decide to buy it back. Again, been there, done that, paid the premium, have the portfolio scars to prove that you never want to panic in buying back an option, or even panic buying a call for that matter, because just as volatility can increase on the way down, volatility does increase on the way up, especially when there's news on a stock and people are chasing calls like crazy. What will happen is the volatility will jack and you will get screwed, put it mildly, because you will be wanting to join the party on some type of news announcement or some type of release from the company. You'll buy the call You'll pay through the nose because volatility is jacked, and minutes, if not hours later, the stock might be still up, but you're still losing money on the call. And all I can say is that if you see a stock running up on news and you're not one of the first ones in, you're better off to buy the stock to play your position than try to buy a call, because it will come back in and you will have paid for a whole lot of volatility that just collapses immediately after the panic buying sets in. Okay. It takes a while for you to get accustomed to this terminology and looking at things, but I'm going to try to repeat some of these things a few times so that you get it. Intrinsic value and time value are two of the key concepts to grasp. And if you have difficulty with it, just visiting the options and going back and forth with it and doing enough of these, it will sink in, trust me, and I'll do my best to help you with that. So, the intrinsic value of an option contract is the value of the option with no consideration for time. It's also the value of an option at expiration. So if Apple is trading at 120 and you own a $120 call, guess what? Your call is worth nothing. So when you buy a call, $120 call, and you pay $2 for it, you really need Apple to be above 122 to make any money at expiration. Because as you get closer to expiration, that option, as we'll talk about, decays and becomes worth less and less, because an option is a decaying asset. So when you're buying a call or when you're buying a put, you always have to, if you're going to hold it for any length of time and you're not just looking to flip it, which you can, I mean, I do it all day, I do it all the time. But if you're looking to hold a call or a put for a longer period of time, you have to remember that if you're buying the 120 strike put or the 120 strike call on Apple, you got to subtract $2 from any gain that you're going to make, because you're not going to break even on Apple unless it hits 122, because 120 is your strike price and you pay $2 for the option. So the first $2 is gone. After $2, you start making money on Apple dollar for dollar. Okay. So a little more explanation of the stock price relative to option price. At the money, the stock price is right at the strike price. Out of the money, the stock's price is below the strike price. So out of the money means no intrinsic value, no real value, it's all time value. Out of the money, stock price is above, out of the money put, I'm sorry, stock price is above the strike price. Stock price is above the strike price. No intrinsic value, that's what you want if you're selling the option. It's not what you want if you're buying the option. And so on and so forth. If you can learn these statements and understand them and grasp them, it's going to go a long way towards your understanding of options. So, and like I said, if you understand one side, the put or the call, easier, just flip that explanation on its head and it makes it easier to understand the other side. Okay. Time value of an option, that's a portion of the value over the premium above its intrinsic value. The more time before expiration, and the more volatile the stock, the higher the time premium will be. So when you are thinking about buying an option when market volatility is elevated like it is now, if you're going to buy an option and you plan to hold it for more than a day or two, you're best to buy a deep in the money option. And I'm going to talk about that more when we talk about Delta. And I know we are past the 2-hour mark. I'm just going to wrap up things a little bit. And I kind of knew that I had way too much material for one session. That's why I said it'll probably be 2 or 3 sessions. But and I also want to take any last questions. But in general, I'm going to schedule the next session to kind of pick up where we left off here. But let me finish with the next couple of slides, and then I'll take the questions and we'll wrap it up so you can enjoy the rest of your Saturday. Okay. So, whoops. Time value will be higher when the option is further from expiration and will decrease as the option gets closer to expiration. And that brings us into time decay. All right. So, said it before, said it again. We'll say it again. An option is a decaying asset. It's not like a stock. You know, I consider stock a fixed investment. It's basically going to go up and it's going to go down based on market conditions and what's happening with the company. When you buy an option, it's derived from the value of the stock. It's a decaying asset. The minute you buy it, it starts decaying. So the clear question that comes all the time is, when does it decay? How fast does it decay? How can I make money off of decay? And the clear answer is nobody really knows. There is a formula for decay. And you can see that in the curve here. Options decay at the square root of time. And as some people say, kind of the wagon wheel runs fastest at the farthest end of the hill. You can see that the closer you get to expiration, the faster the time value decays. Okay. When I'm buying options and I'm planning to hold a stock or an investment for more than a day or two or a week, I'm going to go out at least 30 to 45 days. 45 to 60 days is my sweet spot for swing positions. Okay. Depending on how big I expect the move to be, I might decide to buy in the money, at the money, out of the money options. It's a topic for one of our next discussions. Generally, when I'm buying to speculate or day trade, as you will, if option volatility is not elevated, I'm comfortable buying an at the money or slightly out of the money call. I don't have any problem with that. If I go out more in time, if I go out 45 days to choose that option, I'm comfortable out of the money. But if you have a thesis about a stock and you think that it has a long uptrend ahead of it, you want to give yourself enough time to be right. And obviously, the more time, the more the option costs. If you're only day trading and you're going to be out of that trade by that day or the next day, you know, buy that week's options or buy the what we call the front month or this month's expiring option, the third Friday of this month. This talks about theta, a little bit about the math. You really don't have to learn this stuff. Just know that the closer you get to the option expiration, the faster the time value decays. Remember, intrinsic value is the real value of the stock. That doesn't decay. You will always get the real value of your option when either you close it out or it comes to expiration. The only way you lose the real value is for the stock to lose the real value. The thing you have to worry about when you have options that are short dated, and by my definition, short dated means 2 weeks or less. Okay? What I've found that is when you get to 21 days or less, theta tends to kick in a little bit faster on out of the money options. So I generally, between, if I'm planning to hold an option and my thesis isn't playing out and I still believe in it, when I get to 21 days before expiration, I tend to roll it out to the next month. And that's something rolling we'll talk about. So I'm going to stop the discussion there and finish off with the questions. And then the next session, which I'll schedule in a couple of weeks, we'll start out with volatility and get into more particulars. So M. Bucker, I think I kind of answered that question, but yeah, I mean, everybody tries to figure out in game theta, you know, you have 3 days off for the weekend. If you sell an option, can you take advantage of it? Nobody knows how much comes out before the weekend, how much it comes out after the weekend. It's very hard to gain, but suffice to say, the last couple of weeks before expiration, you're going to get the most bang for your buck. That's why traders really love the weekly options, not the monthly. So if you sell an option that only has 7 days to go, obviously you're going to make your money from the decay a lot faster. But you also have a lot more risk because something we'll talk about, gamma risk, can eat you alive and offset more than the theta decay that you're hoping to collect. Pradeep asks, when you can afford only one weekly call of a stock, when to take a profit or loss? Trading with one of anything is a hard game. And I understand it, I get it. So it's always nice to have two options so that you can take profits on one and then bring your stop to even on the second one. But when you can only afford one, you have to ask yourself, you know, what is my risk reward? If I'm willing to take a 50, if I can only trade one option and I'm willing to take a 50% loss on this option, well, then I should at least, if I want positive expectancy, I should at least get 50% on this option if I'm going to make money over time. It's just about the math. And really, if you want the math to work out, you got to make more than 50% if your loss is 50%. If you're setting your stop at 40%, then a 50% profit will get you to a positive expectancy slightly. And I have a rule. If I double my money on a call or a put in option, I sell it. If I only have one, I sell it. If I have two, I sell one. If I have 10, I'll sell half. Get my money off the table as quickly as I can. And you know, when you have profits on options, they come as fast, or if not faster, than they come. So take your profits when you can, and if you like to live dangerously and you buy options on the day they're expiring to day trade them, know that decay kicks in very fast. So if you want to play with options on expiration and you want to play the game, go right ahead. Do it with small money, lotto money. But if you really are worried about theta decay and you want to play options that are very near dated, you don't have a lot of capital, take a more deep in the money call so that you can at least offset some of the theta decay. So when you go deeper in the money, the theta decay is far, far less. And we're going to talk about delta. We're going to talk about some of the Greeks. And a lot of it is essential to your knowledge. And as you can tell, in 2 hours, there's not a whole lot you can pack in. But thank you guys for the very fine comments. I've been wanting to do this for a long time. And feel free to email me if you have my email address. It's sam@ydfs.com. If you are really interested in options, tastytrade.com is where they have beginner, intermediate, and advanced. They have a lot of content there. Tom Sosnoff has built a really good channel. They broadcast live from 8 a.m. Eastern till 4 p.m. Eastern. Different presenters on options, so it's a way. Tons and tons of videos out there from where do I start and intermediate and more challenging options, and it's 100% free. So tastytrade.com, lots of good free resources. Tom Sosnoff has put a good program in there. TheoTrade is a paid subscription services. They're also a good option, a good choice, but basically it's a subscription service. But Don Kaufman over there, who used to work for Tom Sosnoff, has really built a good service for those who want to learn a lot more about options and get some kind of trade ideas. Any more questions before we wrap it up? Give you guys a couple of seconds. Thank you, Pat. Okay, I'll put my email address in the chat. Okay. You're welcome, CG. You're welcome, Brad. Welcome, Robert. Welcome, Pat. Thanks for the kind words. Pradeep, books. Been trading options for 10 years, a little over 10 years. No good options books out there, really, seriously. Option Volatility by Nate Scheltenberg is kind of the Bible in options, but I've read a few option books. They're outdated, not terribly impressive. I'd say if you're really interested, tons of free videos. Look for Where Do I Start videos on tastytrade.com. Tom has videos where he taught his 20-something-year-old daughter how to trade. Tony Batista, another co-host of Tasty Trade, taught his son how to trade options in live videos, and there's a ton of resources there. You're going to get the most modern take on option trading. And you know, I'll close by saying that You know, one of the mantras over at Tasty Trade is trade small, trade often, and I will echo that sentiment. When you're trading options, and especially if you're starting out, and you know, you don't have to buy 10, you don't have to fling 10 contracts, you don't have to fling 20 contracts. Buy 2 contracts. Sell one when you have a 25% profit, bring your stop to break even, and see if you can ride it through. Or sell it at 50%. Cut it short at 40% or 50%. Try again. The only thing I can tell you about this business is there's a lot of opportunities. And if you're just starting your journey, there's a lot of tricks and traps. And if you have questions, I'm happy to answer them for you via email. I'm on Twitter at TraderGeek. Follow me there. I put out a lot of good information about expected moves and other things, and I expect to put more information about trading options on there. I thank you guys for attending. Dean, thank you for coming. Neil, you're welcome. And Neil, you're welcome. Which tool bit are you asking about? The option trading tool? Thank you, Andrea. Thank you, Mimi. Thanks, Scott. Thank you, Ralph. Thank you, Sita. Hope I didn't murder your name. Thanks, Larry. And the presentation link, I think it's Bucker, is the link is in the chat. We'll scroll up to the top of the chat. Let's see if I can get it here. So I will. There's a link to the handouts, and I will let everybody know when I schedule the next session. Sita, okay. Sorry about that. Think or swim. Let's see, looking forward. Thanks, George. Yeah, I can show more stuff on Thinkorswim in the coming presentation, so I'll do that. So, Brad, I'll send out a link to the recording. This is actually the first time I've ever recorded a GoToMeeting. I've used GoToMeeting with clients all the time, but I've never recorded a meeting. So I'll figure that out after we're done here, and I will send out a link to it. It'll be up in the cloud. So anything else before we wrap up? You're welcome, CM. You're welcome, George. Welcome, Brad. It's my pleasure. You're welcome, Matthew. Welcome, Sean. Dante. Okay, guys. You're welcome, Neil. Thank you. Okay. All right, I think I caught everybody. You guys have a great Labor Day weekend. Thanks for coming, and we'll talk to you again soon. Appreciate it. Have a good weekend. Bye-bye.